What's up, everybody? It is Tuesday, August 17th. Saw a little bit of a market pullback today. I guess it was geopolitics. Got a lot of really ugly stories coming out of Afghanistan. The media is just pounding that situation. It's a tragedy all around. I'm not going to get into it, but let's just say the whole thing is a terrible tragedy. Look, we had to get out. 20 years, trillions and trillions of dollars, thousands and thousands of lives lost and destroyed for what? We had no end game. We had no plan. You know, the Afghans, they don't want Western lifestyles. They don't want to be, like us. We can't change that, all right? And it was just, you can't go on for another 5, 10, 20 years. I mean, I think Biden did the right thing. Even when Trump was in there, every day he was saying, Afghanistan, we got to get out. It's a lost cause. He couldn't pull it off, or he didn't pull it off. He was weak. Biden did it, and he's getting the backlash for it now, but it was never going to be pretty, and we had to get out. You can't stay there forever. You can't stay there forever. Anyway, let's talk about the markets. So yeah, we had that today. We had, and it didn't only affect stocks. I mean, you saw a bid in the dollar. Bond yields came down a little bit. Gold surprisingly held up, but I don't know how much longer it'll hold up if the dollar's rallying. What else? China also ratcheting up the rhetoric today, warning the U.S. to stay away from Taiwan, not to sell arms. So that was probably another factor that was upsetting the market. But look, when it comes to investing, you got to stay, first of all, you got to stay calm, all right? You got to stay in control of your emotions. And you have to stay focused on the fundamentals that affect, if you're trading or investing in the U.S., the fundamentals that affect the U.S. economy. Fiscal flows, still very strong, very supportive. I don't anticipate any interruption in those flows unless we hit the, that October period when the debt ceiling really starts to crunch down. And that's what Yellen said, by October, if these guys don't raise the debt ceiling or suspend it, then there's going to be defaults. I mean, the U.S. will not be able to pay some of its bills, and it's going to be a mess. And that will have a negative impact on the flows, which in turn will have a negative impact on the economy. We saw a weak July retail sales number today, down 1.1%. Now, that number, for me, when I looked at it, pretty consistent with what I saw in terms of the flows in June. And I spoke about this. In June, we saw a noticeable slowdown in the flows because June was when a bunch of states ended unemployment benefits. And I said, leading up to June, when that happens, we're going to see a slowdown in the flows. That did happen for the month of June. In July, as I've been telling you, the flows stabilized and even started to pick up again a little bit. I mean, I'm kind of seeing a modest acceleration that occurred in July. So I'm thinking that the July retail sales number reflected the weakening in those fiscal flows in June. And I think when we get to see the August data, in September, see, that's how most people operate. They wait, you got to wait another month to see what happened the month before. I'm telling you now what it's going to be because the flows drive everything. Anyway, when we see that number, the August number in September, I suspect it's going to be better than the one that we saw in July. We're going to see a pickup. So, the market was upset by that too, that, the narrative was a weakening economy. I think that was a 1 month deal. It had to do with the cuts in unemployment benefits, but other fiscal flows have picked up. You have the child tax credit payments that started in July. Those things I'm noticing in the flows as well, showing a pickup. So I'm not so worried about that. These pullbacks for me still represent buying opportunities, okay? You don't have a very high long commitment in this market on the part of institutional asset managers, at least when you look at their futures positions. All right, that's something. Sentiment, I have to think now with everything going on with Afghanistan and all this other stuff, that sentiment is starting to turn really negative, and I think the put-call ratio is also starting to show the same thing. But when we get to see the AAII weekly sentiment survey tomorrow, hang on. New York City, folks. All right, where was I? When we get that AAII sentiment survey, I have a feeling that we're going to see a pickup in bearish sentiment as well. But everything's on track. I mean, or I should say, still on track. Nothing has been, ended in terms of the fiscal support. And I just don't see that happening unless we go into the full, that October period, and you're not going to see any increase in the debt ceiling. And I still think that they're going to come up with something in the 11th hour. I just don't see them allowing it to go to, a place where it's never been before, where literally, you got to stop payments. I mean, it's already starting to show up a little bit. A friend of mine sent me an article today in the credit markets, T-bills that are due in the October and moving out further period are starting to see a spike in yields on fears of a default. It's just crazy. And I said several times in the past, there's no other explanation as to why, Greek sovereign bonds, Italian sovereign bonds, Spanish sovereign bonds, Portuguese, even French and German, there's no other explanation as to why those yields are significantly below U.S. yields, other than the fact that every couple of years, these idiots in Congress threaten to default the whole, freaking system. That could be the only explanation as far as I can see. So hopefully they're not going to do that. I'm going to keep a positive outlook. Look, if they do, right, we'll know. And at that point, there's no question that a shutdown in payments, even if it's a partial shutdown in payments, it's going to have a negative effect on the economy, and the stock market sell-off at that point will be real. It's not just going to be a sell-off which presents a buying opportunity. It's going to be a sell-off that stays a sell-off, because that's, the example that I always use of the swimming pool getting drained as opposed to the swimming pool getting filled up. So hopefully that's not going to happen. As far as the dollar is concerned, look, big macro picture, you have a record amount of reserves in the system. That's dollars sloshing around, dollar supply. You have a trade deficit at a record, U.S. trade deficit at a record fiscal deficits. Under those circumstances, if the dollar were to continually go up, I mean, that basically rewrites economics. It can go up for a while because people are scared or whatnot, or there's a squeeze. I heard that Treasury froze the assets of Afghanistan, so the Taliban can't get their hands on it. Who knows? That might have something to do with it too. But I mean, the big picture fundamentals for the dollar are bearish. You got to sell into these rallies. You got to manage that. Anyway, that's it for today. See you tomorrow. Bye.